employment is actually doing fine. Certainly corporate profits are doing fine. Inflation looks like it's being a little bit more of a problem. That may actually cause the Fed to slow down on the rate at which it reduces interest rates within the broader market. So I find that piece in particular to be an interesting one to watch, and we'll certainly be talking about it as we move towards the rest of the year. Welcome to Life in the Markets. My name is Tim Russell, and I'm joined with Stephen Rohr, my friend and colleague here. And today is Monday, September 29th. We are almost done with 3 quarters of this year. I can't believe it. So as we look back at the week that was, it was clearly an interesting week as the markets continued to digest what was going on when the Fed cut rates 2 weeks ago, or basically a week and a half ago. We had the week start out generally positive. We had some new higher highs. I'll mention that later in our commentary this morning. But at the end of the day, the markets did end up slightly down for the week. The S&P 500 was off basically 0.25%. The NASDAQ was down 0.3%. And the Russell, that's the small cap index, was down 0.75%, so 0.75%. So all of those things sound like it was a rather bad week for the markets. It frankly was fine. It was a normal week. We gave a little back. It was, frankly, it's healthy to see that. Bond yields continued to, well, they rebounded a little bit after we saw the Fed cut rates. So the bond market declined ever so slightly this week. Again, nothing to be concerned about at this point. And then we continue to track things like gold, silver, and oil. Gold was up as predicted. It was up 1.87%. Silver was up, get this, 7% over the last week. Oil was up, I'm sorry to say this, 4.5%. And then we did see Bitcoin, if you're interested in that, down 3.75%. All of that to say, fairly constructive week in the markets overall, even though we did trade lower. So it's interesting to note, I mentioned we had some higher highs. One of the things that came back higher this week was small cap. Russell 2000 did hit an all-time high. We had hit an all-time high back in November of last year. Since then, the markets have traded down. We've come back and rallied a long way, and it's encouraging to see that our small cap index is now starting to eclipse that point. Now, since reaching that high, it did give a little back. Obviously, we're down 0.75% on the Russell, but it was at least encouraging to see we are making some progress. The point that I want to drive home to us this week is that we had 2 different and conflicting data points that kind of creates a moment where the Fed needs to pause and consider what its next move is going to be. Conflicting, we have the PCE, that is the inflation measure, the preferred inflation measure by the Federal Reserve Bank. And this inflation measure this week came in hotter than expected. We had more inflation than they were anticipating. What that means, obviously, is that things for consumers are getting expensive. It measures 2 different things. So it measures goods and it measures services. So on a core basis, when we put them all together, we see that the inflation rate was 2.9. Pause. Do you remember last week when we said, hey, inflation came back, the CPI, the PPIs, these numbers were in, and those numbers ended up being 2.9%. So CPI and PCE, those 2 inflation reads are showing the exact same number. To me, that's a particularly interesting thing. They don't always agree, and it is interesting that they agree right now. The second thing to note, I said it's got 2 components to PCE, goods and services. Service inflation was actually higher than any of the other measures. It was actually 3.6% higher than what it was a year ago. So the services that you use, whether it's tax preparation or whether it's an Uber ride or whatever else, those things are getting more expensive, and that is showing up in our inflation readout. On the other hand, you said there are two conflicting points. Inflation says, hey, be careful about dropping interest rates because inflation's getting a little too warm. On the other hand, we had employment come back, and the weekly report for jobless claims was lower than expected. So last week we had a little bit of a higher number. The week before that we had a higher number. The 4-week average is, I think, 240 some thousand jobs lost every week. This week, we actually came in well below the average, kind of brings us back down into the normal range where, frankly, at this point, it doesn't look like jobs and unemployment is really becoming more of a problem just based on the weekly jobless claims. Obviously, we're going to get, by the end of this week, the monthly jobs number. So that may or may not confirm this point, and that's certainly something that we'll be talking to you about in the weeks to come. What this means for the Federal Reserve is they've been looking at these 2 points. They say, we're less concerned about inflation than we are employment. Therefore, we're going to lower interest rates. They're now indicating that there should be another half of a rate cut or 0.5% rate cut by the end of the year. With now what looks like it could be developing is employment is actually doing fine. Certainly corporate profits are doing fine. Inflation looks like it's being a little bit more of a problem. That may actually cause the Fed to slow down on the rate at which it reduces interest rates within the broader market. So I find that piece in particular to be an interesting one to watch, and we'll certainly be talking about it as we move towards the rest of the year. 2 more data points I want to share with you before passing this over to Stephen. We talked about mortgage rates and that after the Fed cut rates, mortgage rates had been dropping prior to that and then kind of went up after the rate cut announcement. We did see rates last week come back a little bit lower. So again, nothing major, nothing significant to report other than the trend of mortgage rates, 30-year mortgage, does seem to continue to be easing a little bit, which is going to help new home purchasers to be able to get a more affordable mortgage. And then the last point, on the new home front, we are seeing that home sales increased sharply last month. We had 800,000 transactions compared to 664,000 just a month earlier. So the transaction volume there is encouraging. They were only expecting 650,000 homes sold. To get that much of a surprise is a very good sign. With that, Stephen, you had a couple observations that you wanted to share with us about the job environment and the employment environment and what it tells us a little bit about our workforce. So why don't you talk to us about that?
Absolutely. Thanks, Tim. Yes, in reading different things last week, I saw some interesting points. So workforce participation, so that is the people who are looking for work or currently employed. That has actually fallen. And in digging into the data, David Bahnsen had an article on this where he dug into the details of it. But turns out that only 89% of prime-aged men aged 25 to 54 are participating. So that means only 89% of them are looking for work or working currently.
Yeah. So just remember, we're excluding anyone 55 and older, and we're excluding all the kids in college, right? 50 or 25 and below. Just Correct. Looking at prime age males, just them, 11% of them are not even looking for work.
And that compared with 1960, when that same demographic was participating 97.5% in the workforce.
Yeah. And that's what we would expect, right?
Correct.
Yeah.
Dramatic change.
So just a point of clarification, you said in your comment that those numbers came back lower. Is this like a surprise, a brand new thing, or is this part of a longer trend? It's been trending lower, and now we're pointing it out because we're concerned about it. Which is it?
Great question. So it is part of a long-term trend, but it is still increasing. It is still getting worse. So it is both continuing to be a concern, but it has also been a growing trend for the past several decades.
Got it.
Yep. So I think it's important to remember that there's a reason that God made us to work. Think of 2 Thessalonians 3:10-12. For even when we were with you, we would give you this command. If anyone is not willing to work, let him not eat. For we hear that some among you walk in idleness, not busy at work, but busy bodies. Now such persons we command and encourage in the Lord Jesus Christ to do their work quietly and to earn their own living. So I think combining this and also noting that unmarried men who are receiving some sort of government support, welfare, some other form, they form the largest portion of the inactive men.
Wow.
Probably not shocking, but it is interesting that married men are still participating very highly. Women, on the other hand, if you look at that demographic, they're actually participating at the highest rates ever, 78%. So I think this is really fascinating, given another data set that I saw from the University of Minnesota that showed married men dramatically outperform and out-earn all the other groups. Unmarried men, unmarried women, and married women.
So you're referring to their earnings, how much their wages are?
How much their wages are, which is, and this is a helpful screen to show that unmarried men are also earning less. So it's not just a gender gap. It's actually a purpose and passion, and therefore the value that they are providing in the market due to their drive to provide for their family. And I think that pairs so interestingly with God's overall design. So if we look at God's design for men, Genesis 2:24, it's to marry. So therefore a man shall leave his father and his mother and hold fast to his wife, and they shall become one flesh.
Yes.
2, it's to work. Genesis 2:15. Then the Lord God took the man and put him in the Garden of Eden to work it and to keep it. And 3, to provide for his family. 1 Timothy 5:8. But if anyone does not provide for his relatives, and especially for the members of his household, he has denied the faith and is worse than an unbeliever. So I think when you actually look at the data, how often it bears out God's design is so woven into our DNA that it shows up, and it can't be hidden, it can't be ignored. It has real implications in the economy, in society, and in all aspects of our life.
So, takeaways. Getting married, starting a family, as opposed to the conventional knowledge, I can't start a family until I get my ducks in a row and get my job going, my career going. In fact, we find the data supports getting married, starting a family early actually creates the environment where you as a male provider are incentivized to provide for your family, to get out there and provide value in the markets. So we still acknowledge, yes, you have to be wise, you have to follow the leading of the Lord, you have to obviously do these things in a right relationship, get married, then have children, those things. But there's some real good scientific data to support what we've known for millennia in the Christian world, that men are to leave their father and mother and to provide value in the world. By the way, economically, It is absolutely in our economic best interest to continue to populate this earth, to continue to grow the human race, and to provide for a future. Don't worry about all of the other naysayers about the collapse of the economy and society. The reality is, Christians and Christian families are the answer to all of our social, political, and economic problems and challenges. So have kids, have families, encourage your children and your grandchildren to be fruitful and multiply. It is a good thing for us.
As Proverbs says, the strength of a prince is in the multitude of his people. And as we are facing worldwide population collapse, the economic disaster that is about to inflict on China, on the West, is 100% bearing that up again. It turns out we should listen to what God says.
Shocker. Shocker. No one saw that coming.
No.
All right. So as we wrap up our thoughts this week, I just wanted to give you a couple notes about things to look forward to here over the next week or two. The first thing I'll say is that we have a very special episode coming to you next week. We're going to do a mid-year market update and kind of review where are we year to date within the markets, talk about what happened in this last quarter, and give you a sense of what to expect maybe moving forward. Obviously, all forward-looking statements and comments are only as good as they're accurate. We have to trust the Lord for all of that. The other thing I'll note is just a week from now, we, the advisors at the Life Financial Group, are going to be at a conference down in Memphis, Tennessee. So just bear that in mind. This week we'll be here. The next week we will be off at this conference. So there will be a little less coverage here in the office. So work with our team as they try to continue to meet your needs, and work with us as we're out of the office doing important work, making sure we learn and grow as individuals and as advisors to provide even more value to you, our clients. The verse of this week comes from Proverbs 11:28. It says this: "Whoever trusts in his riches will fall, but the righteous will flourish like a green leaf." It seems very self-explanatory to me that riches, as wonderful as money, wealth, and possessions can be, and certainly it is the case, it can be good if we trust in it, if we make our hope and our confidence in the future based on how that is doing, we have a very rocky foundation. 1 Timothy talks about don't put your hope in the uncertainty of riches, but to trust in God, who richly provides us with all things to enjoy. So what should we focus on? Yes, we manage and protect our wealth, but focus on righteousness. Focus on growing in your relationship with God and pursuing Him. Make Him your chief desire and treasure, and then you will flourish like the green leaf. God will certainly meet you as you seek Him and pursue Him. And if you have questions about how to grow in your relationship with God or to start a relationship with God, reach out to one of our team members here at the Life Group, and we will be happy to share more with you. Until next week, take care, God bless, and be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.